Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management, where we attempt to be the voice of reason in a world full of the pundits of pessimism and the wall of worry. As always, please make sure you read the disclosures that were attached to this video, or if you happen to be watching on social media, you can simply go to www.frossandfross and read any of the disclosures that you might find therein. So today is Tuesday, March the 28th of 2023, and I thought that I would briefly address what's going on in the banking sector, which has been a little wild and crazy in the last couple of weeks. Recent uncertainty in the U.S. regional and global banking system has affected both the stock market's performance and the Fed's decision making. Now the Fed has a pretty difficult job of balancing the tasks of supporting the banking system while at the same time continuing to battle inflation. For this reason, it appears that the Fed is pretty close to probably pausing in this rate hike cycle. How is all this affecting the stock market? Well, investors seem to be more defensive minded. How do we know that? Well, because they seem to be gravitating to sectors like consumer staples, healthcare, and technology. We see those sectors outperforming. Bond markets have not been that safe from volatility lately either, as investors flock to safer investments and anticipate more rate hikes. The yield on treasuries are trending lower, and the yield on the two-year bond fell from a little over 5% to just under 3.8%. Now, while turmoil in the banking industry has caused concern, early signs of stability are appearing in the form of mergers and restructuring in both domestic and international banks. We feel this is a good thing, even in the face of continuing concerns about some U.S. regional and European banks. We expect the confidence-fueled banking turmoil to continue to cause volatility in the near future. However, we do not currently see signs of systemic risk or widespread failure like we saw back in 2007 through 2009 in the midst of the financial crisis. What we may see is continued economic slowdown due to tighter credit conditions. The good part is that this could help to lower inflation, specifically service sector inflation, and hopefully allow the Fed to pause future rate hikes. In fact, the Fed indicated that it may be very close to the end of its rate hike cycle. This will likely cause markets to move toward an expectation of rate cuts in the near future. During the March meeting, the Fed raised rates by 1/4 of a point, where up to this banking problem, most were expecting that to be at least 0.5%. They also reiterated its stance that their peak Fed funds rate, the Fed feels should peak out at 5.1%. This means that we may just have one more rate hike of 0.25% further in the year. Overall, we expect continued near-term volatility in both the stock and bond markets due to, in particular, to the bumpy terrain in the banking sector and the time it takes for the public to regain confidence. That being said, a mild economic downturn in the next months, probably end of second quarter or early third quarter, we think that that's very plausible. Regardless, there continues to be equity and fixed income opportunities because markets which are forward-looking will anticipate a recovery in the coming months. Well, we hope that you're enjoying the warmer weather with friends and family. We encourage you to reach out if you have any questions or concerns. As always, it's a pleasure working for you. Have a wonderful day.